Welcome to Modern Farm Business Podcast. This podcast is designed to help the farm leader bring their business to the next level. We'll cover everything from leadership and finance to strategy and planning. I'm your host, Dean Hefta. In farming, everything we produce gets to the final consumer through some sort of market. And when your focus and experience is on the production side of the equation, the rest of the players in the market determining price can seem sometimes mysterious or even confusing. To add some clarity to the market and remove some of that mystery, Rich Feltus is joining me on this episode. He's head of market insights at R.J. O'Brien, the largest independent futures brokerage firm in the United States. He's well known throughout the commercial and institutional trading world for his comprehensive analysis and commentary on grain and oilseed markets. Thanks for joining us today, Rich.
My pleasure.
So, Rich, there's a lot of topics that farmers ask questions about, but often aren't well explained. And let's just get into it. Tell me about who the funds are and what do I need to know about them?
Well, broadly speaking, there's two categories of funds, the index funds, and that's the component of our marketplace that basically have long positions in commodities as a fixed part of their portfolio. And those are funds that don't change much from week to week, month to month. They may rebalance their positions at the end of the calendar year to bring them in line with their overall weighted basket portfolio. But generally, the index funds are fairly stable and really not a market-making or market-moving factor. In terms of the other component, the managed funds, that is the component in the marketplace that does change on an ongoing basis. It's a very dynamic position. The managed funds trade both the long side and the short side, whereas the index funds are typically just flat out long in the market and permanent residents in the market. The managed funds, those are reports updated along with the index and the commercials on a weekly basis with the CFTC report. Comes out 3 o'clock every Friday afternoon, Eastern time. And it is a rare kind of glimpse and peek into the market. This is something we didn't have years ago, Dean. In fact, I was instrumental, along with the Commodity Markets Council, in pressuring the CFTC to release this data, and it was a big deal when they finally started this more transparent release of this information, which they've collected for years. But in any event, Friday afternoons, that gives us an indication. What's important to watch in this regard is the managed fund component, and to see the extent to which they are overextended, either on the short side or the long side. And when one can really make some money trading, or as a risk manager, as somebody that's managing risk on a commercial end, either as somebody buying the grains or somebody, a farmer who is an intrinsic long and who's selling grains, what really makes a difference is when we have an overextended position by the managed funds and some sort of trigger occurs, some sort of a fundamental changes that prompts them to reverse their position. Typically, they build up their positions either long or short, incrementally and slowly. But if there's a major change in the fundamentals, they typically head for the door in mass all at the same time and can cause violent price reaction. So it's somewhat of a two-step approach, not only to be aware of where the managed funds are, especially if they're at extremes, but also importantly, if there's an underlying shift in the fundamentals, that can really cause a reaction.
That's really helpful. So when we look at the managed funds, the managed money, they call it, we think of them as a collective thing, but there's lots of different independent players in there. Could you give us a flavor for who and how are those players acting? How are they making decisions? Can you give us some insights into that?
Well, that comprises basically investment capital that investors are putting into hedge funds, active commodity traders, commodity trading advisors. They're all accumulated into this sort of net positions. I mean, within the managed fund family, within that grouping, this is just a net of all of those positions collectively tabulated by the CFTC. But they, at the end of the day, represent individual investors who have given their capital to a hedge fund, a commodity trading advisor, perhaps a pension fund, folks that have, some sort of a track record of positive returns on investor capital, who they trust thereafter to make investment decisions on their behalf. So these are large money managers that are doing it full time, that are watching the fundamentals carefully. They're watching the charts and the technicals carefully. In some cases, these managed funds are backed up by algorithmic mathematical trading programs as well. So a lot of different components, but again, netted out to this managed fund position that we look at every Friday afternoon. But importantly, remember that there's a time lag involved in the reporting of this data, because when we see the updated numbers on Friday, they are just good through the close of trading the prior Tuesday. So there's 3 trading days, Wednesday, Thursday, and Friday, that are not tabulated in this managed fund position when it's released on Friday. And there are weeks indeed when we can see, major changes in prices in 3 days, Wednesday, Thursday, Friday. And because of that, you have to be able to tweak and adjust those managed fund positions depending upon what the market has done since the close of the official CFTC reporting deadline on Tuesday afternoon. Now, fortunately, there are services in the industry. We watch them as well that actually do a day-by-day count of the managed fund positions. We call them bean counters that, at the close of every trading day will give you an estimated change in the managed fund positions. But that is largely guesswork. Some would say it's hearsay. There's certainly weeks when they're terribly unreliable, when the CFTC positions come out and they vary considerably from what the daily bean counters have suggested. So in any event, it's a little bit of an art, but nonetheless, the value that report provides, I think, to traders is certainly worth watching and being aware of. And most of your competent, I would say, high-end futures commission merchants, commodity brokerage firms, they have people on staff that are watching this very carefully, and they are commenting on it in an articulate, helpful fashion in their reporting that comes out either on Friday or on the weekends prior to the beginning of the next trading week.
That's really helpful, and I appreciate your effort in helping to bring that transparency to everybody that's in the market. And in that report, there's also the commercials, and you mentioned that earlier. Give us a flavor for who all makes up that commercial side of it.
Well, those are largely the low-hanging fruit on that is the big grain companies, A, B, C, D, ADM and Bunge and Cargill and Dreyfus. The commercials that largely, are absorbing the grain at harvest and then merchandising it out through the balance of the marketing year. It also comprises their major users of grain, the Tysons and the Purdue's, the other large livestock entities within the trade because they have positions in the grain markets. And that can vary depending upon their view of the market. At Tyson, for example, may be along the board because they are of the view that prices are going to be advancing as the marketing year advances. Or they may be simply flat or even short the board if they are of the view that prices are high and the market's going to be declining over time. So all of that, their position somewhat reflects their view of how the market's going to be unfolding. But for the most part, your grain companies are essentially, for the most part, longs in the market, and they absorb the hedges when farmers are selling grain and they take ownership of the grain. So at the end of the day, the commercial positions in the CFTC report from week to week, they don't vary nearly as much, again, as the managed fund component. That is the turn wheel that deserves the most attention. And that's the item that we try to show graphically, how the managed fund positions are swaying from long to short.
Right. The other thing that comes up in the markets is the term open interest. Could you walk us through the basics of what open interest means and what I, as a farmer, should know about that?
Well, open interest is just a summation of the participants in the market. If somebody buys a contract and sells a contract, the open interest is one. And typically, from a technical standpoint, I would say this is more of a tool that the chartists use and the technicians use. Typically, if a market is advancing and the open interest is going up, that means new players are coming into the marketplace. Advancing open interest and an advancing board is typically a sign that there's new money coming into the marketplace, and that is advancing the board. Now, it can also work in the opposite direction. If a market is declining and open interest is advancing, that may be an indication that there are new shorts coming in that want to be short the market because they feel that prices are still headed lower. But if we are, for example, in a situation where the markets have advanced and the open interest has advanced as well, and then you start to see the open interest leak and start to come down. In most cases, that starts happening before the board breaks. That's an indication that a lot of the bull news is in the market, that it's discounted, that it's priced, and it may be an early indicator that the board itself is starting to roll over and break as well. So we look at open interest every morning as confirmation that a particular trend is still in place, or if we see it starting to flatten out and the news is still good, that's an indication that markets may be topping out short term, or for that matter, reversing to the downside.
So just so I'm clear, one of the things you watch for is if price is in a downtrend and you start seeing a change in open interest away from that trend, that gets your attention. And the flip side is if the price is in an uptrend and all of a sudden the open interest starts falling, that also gets your attention because something's not correlating.
Exactly. It's a useful tool. I mean, we don't put all our eggs in one basket. I mean, it's a function of we're looking at open interest, we're looking at the managed fund positions, we're looking importantly, I think one grossly overlooked tool is how the market reacts to the news. If we get bullish news and the markets can't react to that bullish news, that's another important tool, another warning flag that we use. And certainly weather fundamentals, another tool is what the overall larger backdrop is of the CRB, the Commodity Research Bureau Index, which is primarily driven by what's going on in the crude market, because two of our commodities, especially corn and soybean oil, because of the linkage via biofuels, are very closely tied to what's going on in the energy market. So we've learned over time, I think your more seasoned, experienced analysts, risk managers, grain traders are also keeping one eye on the crude oil market and having an opinion about that, because that's simply another tool in this toolbox of all the things that I've mentioned that can be helpful in making informed calls on market direction.
Great. Rich, you've been around the market since the 1970s. What are some of the biggest changes that you've seen from a character standpoint, or just how the market is working that's important for people to understand today?
Well, I think the markets are much more efficient than they used to be. I think there's far less insider information than we've had in the early days of my career in terms of the commercials having sort of an inside track on what's going on in the cash markets. I would say the efficiency of news distribution and the speed at which news is distributed either via social media or news services has increased the efficiency of the market. So I think those are important changes. In the last 5 to 10 years, an important new component of our trade has been the computer-driven systems, the algorithmic traders that build their buy and sell programs simply based on mathematical models. Case in point, on crop report days, they will pre-program in buy and sell points linked to what the USDA may say at various production levels, and within milliseconds of the report being released, those algorithmic funds are already executing trades in the blink of an eye. Before I can even write down what the corn production number is on the August crop report, the algorithmic traders already capitalizing on those numbers with their, very efficient pre-programmed order entry that executes their trade. So I would say that's a major change. And the other thing I would say that's changed is that we are far less U.S.-centric in our price discovery in the ag markets because of the rising dominance of South America, Europe, the former Soviet Union as major producers and competitors of grain. And increasingly we have to be aware of what the global picture is. So just off the top of my head, and I'm sure there's more, but those are the main changes that I would highlight.
This has been really helpful, Rich. Joining us today has been Head of Market Insights from R.J. O'Brien, Rich Feltus. Rich, thank you so much.
My pleasure. Have a great day.
Well, I hope some of those insights from Rich helped add some clarity. We just scratched the surface on a lot of the moving parts of the markets, but every piece that we can understand can help us make better and more informed decisions of how price is discovered and how we can plan and manage those movements of price in our operation. Thanks again for joining me this week, and if you have other things that you'd like to learn more about around this topic or any other topic, send me an email, dean@modernfarmbusiness.com. Also, be sure to subscribe to this podcast where you get podcasts. Tell a friend about what we're doing here, and I look forward to visiting with you again next week. Thanks.